Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an amazing guest in Mr. Charles DeHart. Before we dive in, I wanted to ask a quick favor. Would you mind please heading over to iTunes and taking an extra 30 seconds to rate this podcast with 5 stars? This helps us get more listeners, and it also encourages me to know that people are tuning in. Thank you so much for taking the time to do that. All right, let's dive in. Charles DeHart spent over 8 years in the military, first as an aircraft technician in the Air Force, and then as a sniper in the U.S. Marine Corps. After that, he spent more time overseas, serving as a government contractor in Baghdad. Charles is a well-known former mobile home park owner who has owned and operated a portfolio of mobile home parks worth in excess of $75 million. Charles now works with Glenn Esterson at Marcus and Millichap as an agent, assistant, and operations manager. He is also buying a few parks opportunistically with his current business partner, Dylan Marma. Charles, welcome to the show.
Hey, thanks for having me, Andrew. It's a pleasure to be here.
Awesome. Well, I'm really excited. You're one of my idols in the space. I've heard you on several different podcasts. Maybe you can tell us about your story and our listeners a little bit about your story and how you got into manufactured housing.
Yeah, so my start was Frank and Dave boot camp. That was my entry point. And so as around 2013, I was still working overseas in Baghdad, and that the job that I used to work at, everyone had a little scheme of how they were gonna. It paid really well, so it was always, how am I gonna, nobody had a college degree and whatever. How am I gonna replace this income and not have to work in Baghdad anymore? And so the mobile home parks became my little scheme. A lot of guys did stock trading. A lot of other guys did. Some guys were doing little companies in oil field work and setting up, tactical shooting courses. And I think I was the only one there was 2 other guys doing real estate, and I was the only one doing mobile home parks. So that was the weird one. But it took about 2.5 years to go from learning about the industry to finally buying a park and then leaving Baghdad and starting full time with Kevin. So Kevin was my mentor and business partner getting started. We met during that time period, and it was through buying parks that I was able to get enough passive income to finally start living in the United States again. And then I moved down to Florida, and we started doing things full time. And over the course of maybe 3 years or so, we built Sunrise, and that went really well. And then I transitioned over to brokering, and that's kind of where I'm at today.
Wow, that's fantastic. So, what was like the initial kind of thing? Was it you came across Frank and Dave's content somewhere and kind of got glued in, or what was it that really piqued your interest?
So I first started doing contracting. It was 2012. It was 2011, 2012. Got overseas, made a pretty good amount of money. So I came home with I went there with almost nothing in my bank account and left with about 50,000. So
wow,
that was the most amount of money I'd ever seen at that point.
And was that like security detail type of contracting? Okay.
Yeah, it was so the State Department, it was the embassy in Baghdad, and the people that worked at the embassy needed to go meet with either local officials out in town or in the green zone, and we would take them to those meetings. It was actually a rather boring job. We didn't work that much. We didn't work that hard. But when we did work, we were usually, taking some guy out to some meeting and sitting around waiting on him to get done and then take him back. But it paid really well. And so when I came back, I had moved in with a friend of mine in Atlanta, and his landlord lived in the same building. He was house hacking a quadplex, and he was the first guy that really turned me on to real estate investing. My grandfather had, he had sort of mentioned it. He had a couple of rentals, and I kind of learned a little bit from him, but that was the guy that really, once I had money, he was like, you should start buying some rentals in Atlanta. And because Atlanta at that point in time had been crushed by the recession. Like it was every bit as bad as it was in Florida, in Atlanta. And so I got started doing real estate investing, doing that, bought a handful of rentals. But sometime maybe a year and a half into it, it was the day I was heading back to Iraq. One of my rentals I was selling, and it was like the night before I was leaving. I don't know if it was a crackhead or something, broke into the house, and the agent told me that it was the most amount of damage he'd ever seen in a rental property. They tried to steal the HVAC. They made it to the wood line and just couldn't carry it the rest of the way. So we were able to get that thing back, but they busted all the pipes in the house. The place was flooded.
God.
They stripped all the copper wiring out. It was a disaster.
So I take it this was like an affordable housing type of rental.
Yeah, it was a rougher neighborhood in little part of Atlanta called Decatur.
Okay.
I had a good renter in there, and looking back, I mismanaged the selling of that. I thought that someone buying it would want to live in it. I didn't realize that was probably a rental neighborhood. And so I had talked to the tenant and non-renewed their lease, and we had it all worked out to where, they were able to find a place to go. But it was literally the day that, probably a day or two after she moved out, when it happened. And what it ended up being, we were in a cul-de-sac, and the neighborhood behind us was extremely rough. And it was someone that came in from that neighborhood that did it. But that was pretty much the experience. That was like, oh, I'm about fed up with this. I'm going to have to find some other thing to do. And it ended up being multifamily. It was what I started looking at, was apartments. So I was looking at apartment buildings that were maybe 10, 20 units. And I was working with a couple of local brokers. And when I came home the next time after that, one of them took me through a mobile home park, and the owner of that place walked me through the business model. It made sense. And that's when I started looking around for something. And Frank and Dave had the only thing at that time period. That was the only place you could learn anything about it. And so I went back overseas, scheduled to be they were doing a thing in San Antonio, and right on the end of 2013, ended up attending that course, and I actually got some time with Frank to talk through what I should do to get started. And he told me to build a database. And so for 2.5 years, that's pretty much all I did, was build a database for 2.5 years. Cold called a little bit, but pretty much just nose to the grindstone, just databasing for just 2.5 years.
Wow.
So just to find one park. It ended up serving me later on to buy mini parks, but when it started out, I found it so difficult to get one that it was just like, maybe I got to make this thing bigger or something. So I just made it. It was humongous by the time I finally bought one.
That's fantastic. And I know you did an interview with Ryan Norris all about your database. And I know you've been called the database genius by more than one person. So that's awesome.
What wasn't very genius is that I built it all myself, which now being in business, like professionally, that looking back, that was a humongous mistake. But building it myself, like it's like in my head. So I can reference it because I've just seen it over and over again for 2.5 years. I've almost memorized the thing.
And have you used that then on the broker side of things? Has that come in and helped you, kind of keep cultivating those leads, obviously?
It has. And it's something that for brokers, that's it's probably unique in the park buying side of things. I don't think a lot of people have gone that route, but all brokers have done that. Anyone who's been in the business for 5-6 years, I mean, they've done exactly the same thing that I did. And so Glenn's got a database every bit as big and impressive as the one that I've got. And same thing, he's got that thing memorized, and, you know, he's probably even better at it because, you know, I don't do most of the calling or anything like that. So he even, you know, has the benefit of knowing the people personally that are in that thing.
That's awesome.
So it's, you know, brokers are very familiar. It's not that impressive for them to do that, but that's really how I got started. So
that's great. And maybe you could tell us just how you came across Kevin Bupp. For those of you that aren't familiar, Charles and Kevin worked together to help create Sunrise Capital, and that was the first fund, right?
Yeah, both. We did 2 funds. We ended up buying, I think, around 20 parks together.
Oh, awesome.
So we met. So I when I got back to Iraq in at the beginning of 2014, I started building a database, and I started in like areas of North Carolina that were pretty close to where I grew up.
Mm-hmm.
And so I grew up across the state line in Virginia, but, you know, it was pretty close to Winston-Salem, Greensboro, and you keep going, you get to Raleigh. And so I had that whole place mapped out by, you know, about 3 months in. I had all of it mapped out. When you build it yourself, you start seeing things like, this guy, you know, you can't really quantify it, but this guy might be a seller because of whatever reason. It's something, just looking at large amounts of data, you just come across like, this guy, there's a little bit of something different here, and he might be worth calling. So I started building a little side list. And about 2 weeks before I was slated to go back home, I started making calls on that list. And it wasn't a very big list. It was maybe 20 people. Got down to it was the 13th lead that I had on that list, and he was the guy that I went under contract with when I came home.
Wow.
And that's it. That deal didn't end up closing. By today's standard, it would have been a pretty good deal. But back then it was probably still a pretty decent deal, but for a new guy trying to get some money together, it was more about me not having any experience, and how are you going to manage it when you're not even there, you know?
Sure.
But through that process was how I met Matt Bettinger, which I think you're familiar with him.
Mm-hmm.
And Matt introduced me to Kevin, and that's when Kevin and I started talking. It was June of 2014 was when that started. And so, you know, he obviously saw the opportunity with the database that already built, and he had a wholesaling background from single family. So he really knew what to do with it in terms of marketing to it. And he didn't have a lot of the limitations that I had. For one thing, I hated cold calling. I was not very good at it. But it was also really difficult for me to make calls. So I didn't have good internet connection while I was there. So doing Skype calls most times didn't work out. It either wouldn't connect, or it would drop, or it would do this weird robotic voice thing on the other end. And then I had a really cheap cell phone in Iraq but when it came through, it was a number you wouldn't pick up. And, but I could use
one
my
of those
cell
really
phone.
long ones that is usually like horribly, a spammer, and you're like, no, I'm not answering this. Who's calling me here?
I think the country code for Iraq comes through as 5 digits in front of the already 10 digits that you got. So, so it was
not
like
answering that.
It wouldn't have fit on your iPhone. It would have had to scroll it, and no one's going to pick that up. And and then I used my personal cell phone, but it was about $3 a minute, which wasn't a huge problem, but it did at least tell me the need to like make sure that when I called somebody that there was a good reason to call them. So it wasn't just
I mean, that's probably why you made sure your database, you narrowed it down to those 20 people, and you're like, all right, these are the most valuable leads I have. I'm going to make sure I get get a lot out of these.
It was actually the way that it worked out was very much in line with my previous experience of, you got to prioritize really, really well what you do, because you've only got a couple of chances to do something here.
Yeah.
So it it ended up like, it was probably better that it happened that way. Cause it didn't seem that strange to me to have to do it that way. But, when I got up with Kevin though, at that point we had a cold caller, we were sending out mailers, and that's really where it started to, the light bulb started to go off. Like it could go beyond just buying one park and just, my entire goal was to buy one park, use the GI Bill, go back to school, and then have a job and have this side park to supplement. And maybe I could get close to my income. And then it became, there might be something here where I can make a career out of this. And that's how it ended up doing. It ended up going that way.
That's so cool. And maybe you could tell us from when you met Kevin in 2014, how it kind of progressed into Sunrise Capital, which, is still around doing awesome things and providing great returns, to a huge portfolio of over $75 million. I mean, that's an amount, most people dream about. So maybe you can tell us about your time kind of building up to that, and then your time, managing the fund and operations. I know you had some time there. Maybe you could share that with us.
Sure. At the time, Kevin was in the mode to buy one really good deal a year. That was our mantra for probably a year and a half, at least while I was overseas. It was, we're going to do a lot of marketing. We sent out lots and lots of mailers, made lots of calls. He did make lots of calls, and I was doing the database. So any area that we were like, this is an area that we should maybe try to do something in, I would pick that area up and start gathering all the data on it. And I managed the cold caller too. I was updating like phone numbers for him and trying to manage that process. So it was fortunate because there's not a lot to do overseas when you're doing that job. It fluctuates between, maybe you might get 60-hour work weeks if a big client comes in, like a senator or something like that. You might be working really hard, down to, there were vast amounts of time where we wouldn't work at all I remember one rotation going over there and not working for 13, 14 weeks in a row, not having anything to do for 13, 14 weeks. So, I had all kinds of time to do this. So, yeah. Anyways, it started with that mentality. And when we bought our first deal, it was a massive home run. It was probably worth $1.4 million, and we bought it for $650.
Oh, wow. That's awesome.
The guy wasn't running it very well. So, I mean, on actuals, we paid probably a 3 cap for it, but he was overspending on a lot of things. And when we took over, we just stopped spending money on that stuff. And first year operated, I think we did 160 on the NOI the first year, and we bought it for $650. So I don't know what that works out to in a cap rate, but that's huge, pretty large.
Yeah. So maybe you could share a little bit about those, like what he was spending money on, that he didn't need to be spending money on, whether it's, overpaying for management or what those details were.
So he had done tree work that previous year, and it was a small park, it's 52 units. And I think he spent something like $40,000 on tree work, but really what it was, he had negotiated an hourly rate and didn't really keep up with it. This guy was extremely wealthy, and the park he really had no business owning it. He just owned it. He'd owned it for 35 years or something, and he didn't really care. It put a little bit of money in his pocket, and he just did not care. But tree work that should have cost him $2,000 ended up costing him $40,000.
Jeez.
And it was a ton of stuff like that on there. It was so obvious to pick out, we can probably do better than this, but we were very fortunate to get that deal though. He was a very easy seller to work with. He was very good to us. At the end, he realized a little bit that the park was worth much more. He didn't, he acknowledged it, even acknowledged it around closing time, and just told us he was really happy it was us that were getting the deal. So it was a good transaction. It ended up being the thing that got me out of the Baghdad. So I went back one more time while we were running that park. Did another 4 months there, which I'm sure the guys I worked with, I'd pretty much dropped my pack at that point. I was like, I'm making $5,000 a month in this thing. I don't need to do any of this crap anymore. So
yeah,
I wasn't easy to work with during that last 3.5 months. But I came home in April and moved down to Tampa in October, and then Kevin and I just continued. We ended up buying 5 parks back half of 2016. So we had built a lot of momentum, and things started really, really happening. And by the time we got through all the money that we had and all the credit cards I could advance to get money in deals, our pipeline was still full of deals, and that's when we started raising money.
Awesome. And did you guys go straight into the fund model, or did you guys do any like one-off syndications?
We did one-off syndication. He raised it from his wife's parents. There's a little deal out in Paducah. We did that one. It was an up and down deal. That's really when I think that was our 6th park. And so I've always been behind where I should be, like in a position where I should be delegating, but not smart enough to do it. And that's when the delegating really comes into play, is that 5th to 6th park. Yeah. When you get up to that level, that's where your make and break point is. Can you delegate well? If you can go beyond that. If you can't, you're gonna really wish you didn't go beyond that level.
Yeah, 100% agree. That's a crucial point. I mean, how many lots? Is that right around like 500 lots, maybe a little bit less?
Depends on what size you're buying, but I think it's more about the number of parks, because there's 6 managers to manage.
Yeah.
And 5 managers, 6 managers. If you don't have scalable systems and you can't quickly manage them and make sure they're doing what they're supposed to do, you have a real hard time once you get 20. I mean, when we got to 20 parks, I was dealing with some other problems at that time, just normal things that happen to people when they come home from stuff like that. But to also then on the work side have delegated almost nothing and deal with 20 managers just blowing your phone up at all times.
Yeah, maybe you can share a little bit about that. I mean, I can only imagine, coming home from Baghdad, which is obviously a very stressful environment, to then coming into this kind of bee's nest of managers that, need communication consistently. So,
yeah, the business turned into, for me, something that it was something I couldn't get away from. Like I couldn't take a vacation, because if I was on vacation, normally I was still getting calls from the managers and still needing to do stuff with them. Or I was thinking about like, oh my gosh, I'm going to get called. I know it. And wake up in the morning and the first thought you have is, I'm going to get a phone call, And I did. I had when I came home, I had a bit of a drinking problem, and I had a bit of it was weed. So it wasn't, I guess those people don't consider that drugs, but it was a drug problem. And so I had both of those two things going on while doing all this. And it just became so overwhelming that, and they've been able to keep their business going. But I was in a bad spot for a long time. And so that really was what would characterize the beginnings of Sunrise. Was we all had to deal with that. When one of your partners is going through that, everyone's going through it. And so that was a really tough thing to go through. But, I know they're doing really well now, and Kevin and I talk pretty frequently now. But it was a hard period of time for all of us to go through. And I think we for the most part kept it pretty reasonably quiet. I don't think a lot of people knew it was happening. That was more them. And I've always appreciated that part of it, but it was not an easy go for a while. And Glenn ended up being the guy that kind of pulled me out of that. So
that's great to hear. And I appreciate you sharing that. That's, I think that's more common, with people coming back from overseas than we really consider. So, first off, thank you for your service. I mean,
No, I appreciate that.
that means a lot. And, Glenn, I've spoken with, several times, and very stand-up guy, and same thing with Kevin. I mean, just to be able to kind of keep things going and to cover as needed it speaks volumes for the character of the people you surround yourself with. So.
Yeah, no, I got very lucky. I got friends that, a lot of friends that have gone through the same thing. They didn't have, no one that I know has had the amount of support and dedication from those people around them to pull them out of it. I mean, some people have nobody, so I got really lucky.
Yeah. Well, I mean, from there till now, kind of looking at what you're doing, I know you're opportunistically buying. Maybe you could share a little bit about what you've been up to recently, on the broker side, and then also with Mr. Marma, with your couple of acquisitions, and maybe where you see the market, moving forward.
Sure. The brokering thing has given me a really good education on, just really what the market is doing and who the players are. And it makes me a lot more confident as a buyer. And so I've started buying some things. Glenn and I are still working through how do we make this not a conflict of interest, because him and I both are very committed to each other to continue working together. And we want to make it work to where I can still buy some stuff and then support the brokerage team and do the things that I have been doing for the last year and a half over there. And so we're taking it pretty slow on the buying side of things. Dylan and I we've got a good mentor over there who's helping us out. And we've bought 2 parks already. We got a third one that'll probably close by the end of next month. And we're going to buy a 4th one. And this time we're going to stop and we're going to get everything squared away, make sure everything is properly planned and delegated correctly. And then we'll go forward after that. But that's really what we're doing, the buying side. On the brokering side, we're putting as many coals in the fire as we can get in there. We sold 27 deals last year, which is,
wow.
Our deal sizes aren't, they're normal. I think our average deal size was maybe $3 million or $4 million. So we're pretty inexperienced team outside of Glenn. I think everyone was on their first full year as a broker. So 27 deals was what was important to us, is getting the experience, the motions of closing. And our guys have that now, and we're starting to take on bigger projects. And that business is going very well. It's still very much in its infancy. It still creates lots of stress, and there's lots of ups and downs with brokering anyways. But, I couldn't be happier with the way that business is going at this point.
That's awesome to hear that. So I have a couple questions. The first one I would say piggybacks on the brokering. What are maybe some of the common mistakes you see in the underwriting process of mobile home parks? Maybe you could start there and share that with us.
So one of the biggest things that an owner can do to mitigate any mistakes that a broker might make would be, it's really important to go line item by line item on the P&L and break out the 2 businesses. Our business is unique in the fact that there are, in any mobile home park, there's 2 businesses. There's one business that's capitalized and another business that's not. And so just that quality about it, if it's not broken out and it's not provable and clear, it's very easy to misvalue the property when it's not clear what expenses belong in what bucket. And the same thing with revenues. Revenues are a little bit less of a problem, but there are still owners that dump all of their revenues into one bucket, and you're trying to figure out how to split it out and then prove to a buyer that that's, accurate to at least some degree of accuracy. That's one thing that a lot of owners should consider when they're looking at their own P&Ls and don't wait until like 3 days before you're going to list it either. Like
Yeah.
those are structural things that you should be doing in your company to make sure that, that your exit goes smoothly. You could do everything great and then have an unsmooth exit, and your IRR is not going to look that great.
Yeah.
And that's what you sell your investors on, is that IRR. So, your exit makes up a big portion of that. So, take the time to look through that and make sure that it's pretty clear to at least the person who's going to help you sell it, to give them the best chance of success for you. On the broker side, I'd say the biggest mistake is it's really just that. I think the market moves really, really fast. And so it's really easy to get into big of a hurry, like a big hurry, and not take the time to more or less nitpick the P&L and make sure that we're, doing everything correctly on that side. That's been something that's been challenging for us. We deal mostly with, we'll sell anything really as a brokerage team. We've got no problem selling something that needs to go to auction all the way up to $100 million deal. We've got experience on all of them. But it is something that, there's very little consistency between ththose types of sellers. And so we've dealt with lots and lots of different scenarios, but the biggest thing for us has been that not breaking out the park-owned home stuff, those expenses in a provable way.
Maybe we could, touch on that a little bit, because I know you mentioned capitalized and not capitalized. Just for those listeners that don't know, kind of what you're referencing, the capitalized portion of the income would be the lot rent, where you don't own the homes, right? And it's just, you're paying for the dirt rent. And then the not capitalized would be like the park-owned home income. If you're renting homes or selling them on a rent-to-own type of contract. Right.
Sure.
So I just wanted to make sure we touched on that.
Yeah. Any income that's generated by the real estate, any income and expenses, the way to think about it, the easiest way to think about it is, if you had no park-owned homes, what would that thing look like? And there are some adjustments that would be made if you had park-owned homes. Your real estate expenses will be slightly higher, mostly in the collection loss category. But the park-owned homes, the reason we don't capitalize those is it's basically like a car. So it's essentially, the thing is worth whatever it's worth. And if you took that home in California and put it out there is some adjustment because it's in California what that home would be worth, but it's not on a capitalized approach. So if I got that home down, in a market where I can get, let's call it $600 above the lot rent, if I'm capitalizing that value of that home might be twice what it's actually worth if I was to just buy it from a dealer. Mm-hmm. And so it really is, you're basically referencing like NADA values, which is like a Kelley Blue Book, to price something relative to that value for those homes. And then if you got, if someone's selling them on a rent to own contract, it's a note buying thing. So mobile home parks are, I would have to say, I don't have any experience anywhere else really, but I could imagine how it would be to do a value an apartment complex or retail, any of those things. This is the most complicated one.
Yeah. And there's other components, right? Like if there's a mobile home park, there's an RV component to it. They have some RV lots, those are capitalized differently. If there's self-storage, that would be, potentially capitalized differently. So I agree with you. And it says a lot about you and Glenn as brokers to, look at these types of things and value them the way you do, and NADA values and things like that, because there's other brokerage firms that we've all seen them that are capitalizing that park-owned home income. And, that's where things get scary, because it's not the same value on the income stream that's coming in. So that's a big deal. One of the bigger deals, I think, when buying parks.
We probably spend more time than we should. We like to view pricing as a measurement almost. It's somewhere between where it sits today and what it could be. The market is willing to pay something for the opportunity to go where it could be. We view that as a measurement activity, and we spend lots of time looking at deals that we've done, deals that other brokers have done, trying to measure where market is on that so that we can do the best job for our clients. I don't know what other brokers are doing, but I know we spend probably more time than we should doing that. And that's something that we feel like is going to pay dividends in the long run, because once I hate using the word algorithm, but once you can create some consistent measurement tool for that, which is, our underwriting is a representation of the basic concepts of how we measure price. Once you can do that, then you can move fluidly with the market when it makes changes. And that's what, Glenn wants to be doing this for a long time. He wants to bring lots of brokers in through his program and be a long-standing name. And to be able to move fluidly with the market changes and the measurement tool is critical for him. And so that's why we spend so much time doing it.
Yeah, no, that's huge. That's huge. As we move forward, you mentioned slowing down in your acquisition of parks and doing it right and making sure the operations are ready for the growth. And maybe you can elaborate on that. I know before we started recording, you mentioned that you're kind of pressing pause for 6 to 8 months to kind of get the operations in order. Does that also have anything to do with the economy right now and, the new administration? Maybe you could just share a little bit about where you think the market's going in terms of manufactured housing and, what your thoughts are there.
Yeah, I think we're just well timed with the pause. The market has been, I've not been as concerned, I think, as a lot of our clients have, but there is a general consensus in the market that there's at least a lot of uncertainty and a lot of people telling you what will happen. But I do think it's probably, I don't think it's going to be as bad as most people are making it out to be. It usually never is. And I really don't think that Biden's going to come in and try to shake everything up really, really hard, because if you think about it, our economy is pretty fragile. And so if he starts doing shock treatment on this thing, he might end up with something he didn't want. But there are a lot of changes that he's trying to make, and that's typical for any president in their first 100 days. They feel like they have to go do a bunch of stuff, which is, I don't know, who knows? I don't want to get into that, but outside of that, I mean, we're pushing pause mostly for our own purposes. We got the advice from our mentor that, we're raising a $10 million fund. Our first 2 deals are going to make up about $2.5 million of the allocation. We're looking for a big deal this time, something in the 7 to 8 million range, to take up the other quarter so that we can get to the halfway mark. And it's really, I think from his standpoint, he is really wanting us to have our KPIs in order, have our management systems in order. And 6 months is enough time for us to do that. There's enough scale there to where we will have to develop scalable systems. So we won't, have to be looking at one park and trying to be like, oh, well, imagine it being 50 parks. So we are going through those motions, but one of the reasons that we really wanted to do it was we feel pretty strongly that we're going to hit our numbers on those parks, what we've told investors we were going to do. And so we're kind of taking a gamble and saying, we're going to push pause. We're going to operate them, for 6 months. And then we're going to raise the next half of the fund on the operating history. We provided incentives for the people that came in early. We gave them a ton of extra depreciation and some other perks to get in early. So we've kind of balanced those 2 risks out, but I think it'll just be a lot easier on us to raise the second half of it if we do, a job that we're supposed to do. And so whether it be 6 months, 8 months, maybe it's 12 months, maybe we run into some issues and our operating history doesn't get to where we can raise the other half in 12 months. Whatever it is, that's the process that we're going to go through to do. We don't want to scale too quickly, get a big mess on our hands and then try to fix it. That's what we're trying to avoid.
Yeah. And I think that's very smart. That's similar to our story. We could have raised a lot more money and bought a lot more parks early on, but without the right systems, it wouldn't have been a business that I wanted to be a part of. It would have been a lot more stressful. So we've kind of bolted on employees if they were the right fit, versus just hiring to hire people, because that's one of the bigger things that we struggle with is the human resource component, as I'm sure you guys can acknowledge as well. So that's awesome. So when did you guys buy your first park in the $10 million fund?
So we bought one outside of the fund.
Okay.
In October, we raised money for that one. And then
2020,
good idea.
Just last year?
Yeah, October,
Okay.
the end. It was October 23rd, I think.
Gotcha.
So we bought that one. It's in Jacksonville, North Carolina, right near Camp Lejeune.
Oh, nice.
Ended up being a military town. Most people avoid that for whatever reason, but it ended up being a really good deal for us. And we've done really well with that. It's only been 3 months, but December's always a bad month for collections. If there's any month that's the worst, it's always that one. And also move-ins. But we did really well in December, despite all of that. We got a bunch of park-owned homes in that park. It's 140 park-owned homes.
Oh, wow.
And so, one of the things that I've teased the idea on, at least, is doing potentially large-scale infill projects, which there's not many of those left anymore. Or, looking at development. It's still nothing more than just an idea, but things are starting to happen in Florida where development is looking very, very possible. We already saw a project get approved out in Ocala. So the park-owned home deal has ended up being a blessing for us, because we're getting to, we're really getting to set up our systems to handle large amounts of homes and do large-scale advertising and do large-scale selling activities, those are the things that we're going to need to demonstrate before anyone's going to want to do a development deal for us. We understand that. So, this thing wasn't planned that way, but we're viewing that park as that's the park that is going to create the operating history that we need to at least prove that once the thing is built, that we can do something with it. So we're having fun in that park. It's a really good asset. We bought another park out in Knoxville. That was our first park in the fund. That one's a nice property where we'd like to scale in Knoxville, but it's one of those things where if we can scale in Knoxville, we will. If we can't, we'll probably hold on to that park. We've got a couple of things that need to be fixed until it can get a Fannie Mae loan. We'll probably go back out to market at that point with that park, maybe 3-4 years from now, if we don't have anything else in that market. And then the third park is in New Bern, which is about 10 minutes from Jacksonville. And that's 122 units. It's got 100 park-owned homes, which I know people are on the call like, oh, so you got 240 park-owned homes in one market. You guys are insane.
But what are like the average age of those homes? I think that has a big,
in Royal Valley, that one's 2006. And then in New Bern, 1998.
Yeah, so those are pitched roof, nice.
Yeah, those are nice homes.
Nice homes,
And we got a really good crew. We got a 4-man crew right now. We're going to hire another one once we close, but we got a 5-man crew to handle renovations, and they do really good work. So we're managing their average down days, cracking the whip on them to make sure that our units are rent ready on average the 30th day, and get them leased by the 45th day. And we can do that, then we can maintain a roughly 6% vacancy loss, which pretty good in my eyes.
Yeah, that's huge. Maybe you could share a little bit about kind of your model there. Do you plan on selling those park-owned homes and converting existing renters into owners? Just what's that timeline look like? What's your expectations for converting all of those park-owned homes to tenant-owned homes?
Realistically, there's two things at play. I believe very strongly that Fannie Mae will change their guidelines over the next 5 to 10 years. We don't go into deals with the assumption that that's going to happen, but I'm pretty bullish on Fannie Mae eventually waking up to these park-owned homes are not really that big of a deal. And I say that because there are financiers now like Vanderbilt, First Bank's been in the business for a while, Key Bank and some others that they'll finance these projects at loans that look very similar to Fannie Mae, with only the interest rate being different, 3.5% or 5% versus 3.5%. And so that's the loan that we got on Royal Valley. We got 30-year AM, 2 years of interest only, and 25% down, 5% rate. So the only difference there between that and the Fannie Mae is the interest rate.
Mm-hmm.
And we got that on all of it, the park-owned homes and everything.
Wow.
And so I don't think it's going to be long before Fannie Mae at least reviews their guidelines. Maybe they don't lend on the homes, but maybe they open their doors for properties that have more than, such and such amount of homes, as long as they're newer or something like that. Because I don't think that guideline makes a whole lot of sense for them. Outside of that, it's a long-term plan. We do have, our customer base is the right customer base for those age of homes. So most of our prospective customers can come in, they can put a down payment down. But we're mostly in-house financing those to them. We've got a rent-to-own program. Make it pretty easy. Most of our homes sell at a price point around 20 to 30. We're usually asking for around 3,000 to 5,000 down, and a lot of the loans that are out there available to them are, in my eyes, they're predatory in a way where they stretch the amortization out really long, so they have a long runway of interest. We try to get the amortization. Basically, the payment. If they were to go with another finance company, the payment might be $200 or something like that. Our payments, we keep them at the same level as the rent, and these customers will get through their RTOs in about 6 to 7 years. And so with normal turnover and everything else, we feel like we can probably get within Fannie Mae guidelines by somewhere between year 8 and 10. So
I think that's a good timeline. Gives you plenty of time to kind of roll that out.
Yeah. That's what we're shooting for on those properties. But at the end of the day, they if they're managed properly, they have the highest cash flow of anything that you can buy at a market price.
Oh, I believe that. Like a flat apartment complex, right?
Yeah. So they have a great cash flow. At least nowadays, they have really good debt options. That was the reason not to buy them before. Aside from the operational challenges, it was the financing was very difficult. Now it's relatively easy. So I think there's an opportunity in those properties, but it really is, a lot of the bigger operators aren't set up to take on those kind of projects. So it's really an opportunity for a smaller guy to do. And I think that there's going to be a lot of that out there. If I was starting out, I'd look at those things because they throw off a lot of cash flow, and they're not hard to do nowadays.
Oh, totally. I think the biggest risks are, the potential turnover, right? Being higher than the tenant owned homes. And then, just the relative condition of them. And you got to have a good, rehab crew, like you said, you guys have. But that's just been one of the tougher things for us in the business is finding good, reliable, handyman type of guys that will rehab these things at scale. You can't just go out and hire a general contractor like you could on a multifamily project. These are more the people that, they're too busy. The GCs are too busy. You got to find like a handyman type that's still insured and, has his wits about him. So that's been the toughest parts for us. Would you agree with that?
Yeah, we wouldn't touch one of these things unless we could afford a full-time crew to be on payroll.
Yeah.
That's our criteria with these types of projects is, now that we got into that one in New Bern, that area has a lot of communities that have lots of park-owned homes, which is kind of funny because if you go there, people will tell you that it's a rental area. We've found the exact opposite. We have had all kinds of interest from people trying to buy a home. But, the price points are a little higher and everything else. But in that community, we have enough income to afford a pretty good staff. And if we didn't have that, I wouldn't do one of those with contractors. I just wouldn't go through the brain damage of that.
Yeah. I'm with you there. Our most important question: what are the most important things that passive investors need to look out for when investing into mobile home parks?
What starts with the operator, I think, and it doesn't mean that the guy has to have a ton of experience. I think there's a lot of guys getting in that have a good story as to why they would be successful. So I think it's nothing that's not like groundbreaking or anything that you need to look at the actual operator, but there's a lot of guys that are getting their start right now that are going to be good people to put money with. But
what's a good way to vet an operator, vet someone like that?
If you're going to be a limited partner, you should learn at least enough to be able to interview the person who's going to operate it and get a gut check on, do they know this industry? So if you're going to get into the industry, it's worth learning about it and going into rather good details so that you can do those interviews properly. I'd say the next thing is, I would be open to anyone's idea of what type of deal that they're going to chase, but because there are people out there that chase things that are very, very specific, and that's something I've learned as a broker. But I would just make sure that they're very crystal clear on what it is that they're trying to do. There's a lot of guys out there that are just getting their start and they want to chase after every single thing that comes across and not specialize. And I think that if I was a limited partner putting money out there, I would spend most of my time interviewing people that specialize and do a niche within the industry. Someone who's good at infilling projects, or they're good at expanding parks, and that's what they go after, or they're good at, doing some other, thing, taking something that needs a facelift to go into a higher quality loan, and that's what they do. Just some kind of niche. I would look at that, especially when if you're working with someone that's a smaller operator. If it's an established group, then that's not as necessary. But if you're looking at smaller operators or guys getting their start, I would really want to see them have a niche.
I love that. I think that's huge advice right there. Number one, ask good questions, educate yourself so you know the space through podcasts, books, otherwise. And then, specialize. I think that's key, whether it's converting park-owned home parks. I heard recently there's a new fund that's acquiring only mobile home parks on private utilities. Again, that's a niche, because a lot of operators don't even look at parks with private utilities. So I think that says a lot about the operator and the cognitive side of it. How are they thinking ahead? We had an interview with Rhett Trees at Seneca Capital, and if you ask him what his deal criteria is, he's spot on. We only buy stuff that's going to get a Freddie Mac supplemental loan, and I love that. That was like a huge aha moment for me.
Yep.
So that's really good advice, Charles. All right. I know this has gotten a little long-winded, but I think we've covered a ton of awesome information. One question that I ask every operator is, what does the perfect mobile home park look like in your eyes? What would you say to that?
We have our fund model right now. We have 3, I guess, avatar parks is what I would call it. We like a heavy park-owned home deal to build the alpha on the front end. Then we like to do something where it's a little bit operationally easier, and we can get, either we have a short-term track to a Fannie Mae loan, whether it be at close or within a year. And then we're attempting to round out our fund model. At least this is the idea for now, is that we're hoping that the alpha allows us to build up enough of that early year cash flow to take down a legacy asset, so that we'd like to go into competition at times with the tree houses, the Carlyles, the big boys, and be able to win. And so we think that's a way to do it, and then pull in probably an asset that we wouldn't have any business owning, because we're not of the caliber to be in that discussion. And that's really what we're trying to do with our fund, is It's both a return aspect and also a balance of risk. My perfect mobile home park is that last park, though, is that
The
legacy asset.
And what does that
I
look
don't
like? Is
look.
it,
I know all
is
the
it
reasons why people.
Sam Zell's parks in the coastal areas? What does that look like for you?
Yeah, to me, it's a 55 plus Florida park that's 100 lots. The rents are. I don't want to deal with some kind of got to get the person's rents to market kind of thing. I want the rents to be like within 10% of market. If you're going to leave me the upside, then just leave me like 10 lots to fill in.
Yeah,
And that'll be fine. Give me some margin on home sale stuff. But perfect mobile home park is one where you can get in real easy with a really nice loan. It's big enough to where, just like Rhett said, that you can pull a supplemental out. Well, some of these parks are big enough that time will just take care of that. 5 years from now, time has taken care. You don't have to do any value add, and you get a supplemental. So that'd be my perfect one. Is how lazy could I possibly be? I guess,
but it does the work for you.
Right.
That's key. I love that. 3 avatar parks for your specialization. I really dig that. Charles, thank you so much, man. How can our listeners get a hold of you if they'd like to do so?
Yeah. My email address is charles.dehart@marcusmillichap.com. That's probably the best place. I give you my phone number. It's 276-237-4311. So either place is fine. If you try to get a hold of me in other places, I got so many different places that I'm supposed to be on that sometimes I might not get back to you. So I'm still trying to build the habit of being on like 20 different social platforms, but I'll get there, I guess, or at least I'll hire somebody.
There you go. The delegation we were talking about earlier.
Yeah.
Right? Tell me, do you have a website for your fund with Dylan?
We do. It's the requitygroup.com.
Okay, awesome. I'll put that in the show notes as well. Thank you so much for coming on the show, Charles, and sharing.
I appreciate you having me.
So much valuable information. I mean, there were several golden nuggets in this interview that I'm sure the listeners are going to eat it up. So thank you so much. It was a pleasure having you. That's it for today, folks. Thank you so much for tuning in.
Thanks a lot.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram @Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's @Passive MHP Investing on Instagram. See you there.